Wow, can you believe it's already middle of November? Next week, it's Turkey Day. The day after that, we start the official Black Friday, Super Saturday, Small Business Saturday, Super Sunday, Cyber Monday. uh, if you've been listening to us for some time, and if you've been watching our podcast, you have. We've been discussing the fact that that this retail weekend that's coming up really started at the end of September.
Yep.
Didn't it, CJ?
Yeah. I mean, I think I'm halfway done with my shopping, Tom, just because I've been listening to the ads and saying, hey, get out there and do it early, right? But
hey, if you shop like we do, we get boxes from Amazon every day. Some of the stuff's not even opened. That's how bad it is sometimes. I can actually take a box, shake it, think, you know what? That might be good. I don't know what that is in there, but that might be a good present for my brother.
hey, let me ask you
Wrap
something
it
on
up.
that. Let me ask you something. Is it socially acceptable to just get the box from Amazon and then throw some wrapping paper around it and put it under the tree? Is that okay?
Absolutely.
Now? Okay.
Absolutely. In fact, I know people in my family that literally just take the box there and wrap it. They just put a name on it.
All right.
I mean, there
Okay.
you go. And
Man,
by the way, for the procrastinators out there, and I'm one of them, as far as gift wrapping, I've tried the gift wrapping option from Amazon. All they do is throw it in some sort of a bag, and they do a pull string at the end. So it's not much gift wrapping. It's not gift wrapping. It's shove it into a bag that looks like wrapping paper, and then they pull the drawstrings and tighten it up.
Nah, I think
Not
you
that
got to
good.
go a little further, right? Side note, my dad is the king of wrapping. And I can remember one year he actually canned our gifts. He found somebody that had a canning machine, like steel cans. And we had
Wow.
to use can openers on Christmas morning. It was genius, Tom.
Wow.
Maybe I'll
I have
can
never
something.
heard of that.
I'll can something for you this year,
That's
maybe.
awesome, man. That
Yeah.
is awesome. Well, welcome everybody to the podcast. We're going to be talking about what's going on right down there. We got CPI market slingshot that happened earlier in the week. Retail stocks we want to take a look at. And of course, Bitcoin's past test. I mean, it did pass the test. Where do we go from there? Maybe a question or two as we get at the end of the podcast. But let's start with what happened earlier in the week, CJ. We had a CPI report came out. Was it a good report or was it a bad report?
It was neither. It was an amazing report. It was just what the doctor ordered. If you've been sitting around watching interest rates and watching the Fed and wondering what Jerome Powell is going to do, it was, this is Nadia Comaneci landing, sticking the landing right now. We saw inflation come in much less than expected. And then, Tom, it followed up with a PPI report, the producer price index that just, I don't know how many poker players are out there, but it was like getting a really nice flop, and the market is eating it up right now.
Yeah. Nadia Comaneci, a 40-year-old reference for those of you that are not at the age that CJ and I are at.
Sorry,
Google it.
Yeah.
Anyway. I mean, you know what? I thought when I saw that CPI report come out and then the immediate snap, that slingshot to the upside, I'm like, whoa, this is going to help. It'll help anybody that's long. But you know what? Because I have a couple of different accounts and I put long-term stuff in one account and I got this account that just sells puts. Boy, the put selling account really, I mean, it was long overdue because I'm going to say, I got to tell all my my fellow traders out there, selling puts in September and October was not a great thing to do because I'm selling puts on stuff that has high implied volatility, and that stuff was going down.
Right.
And I mean, we went down into even last week, and then all of a sudden, this report came out, and of the last couple of days, I've seen. Now I'm real conservative too. I mean, I do what's called cash secured put selling. So I only sell puts to the amount of cash I have in the portfolio. I do zero leverage on it. I say that because I was doubling the index rate of returns over the last couple of days because I had stuff that was in the money that was jumping back up. And then B, I had time value that was coming, or I had volatility and time value that was coming down that was just actually adding to it too. So when the market went up 1.5% for me on what, Tuesday, I was getting 3%. When the market jumps up 1%, I'm getting 2%. And that's been happening in the last couple of days. It was a very well needed gift to those of us that are premium sellers that have went from out of the money to in the money. And so we're now back to, let's call it at the money. But my put selling account is actually at highs for the year. And a lot of that happened because of what just happened in the last week. So that was exciting because, now we're going into, we've got expiration day, the 17th, and I got a lot of options that are expiring that were in the money that they're now at the money and even slightly out of the money. And then there was some stuff that got assigned to me that just popped up too, that is now back to where I was originally. So yeah, it's amazing. They say this, I hear this all the time, that if you're not in the markets, if you miss out on the top few days, those big days when the S&P makes the moves, you miss out on something like 75 or 80% of the action happens one day a month. One day a month. If you miss that one day a month, you're missing 80% of the move. That's why if you're long-term buying and holding makes sense on the right assets, the right securities. But you know what? As a put seller, as an option trader, same exact thing. I was on a podcast, not a podcast. I was with a group on Monday, and we were looking at seasonality, and we were looking at something I want to show everybody. Let me bring it up, show everybody right now. So this is something that we did at the beginning of the week. So what this is we did a look back. This was before the CPI report, CJ. We did a look back, and we said, hey, let's go look back at SPY. Let's look back at the last 10 years that happened around Thanksgiving. And what we can do is we can say, what did the SPY do the 5 or 10 days all the way to 30 days if we want before Thanksgiving? We were actually looking at 10 days before Thanksgiving. So, slid this down to 10. And then we can look at before, we can look at after, we can look at in between. This thing ran 50 tests, and it was telling us you're getting 1.5% on the S&P in the 9 of the last 10 years, 8 of the last 10 years, winners and losers combined. You're getting about 1.5% move those 2 weeks prior to Thanksgiving. And so we talked about that on Monday. I bought calls on SPY. I also bought some calls on NVIDIA because, you got those earnings coming up next week. And I'm looking at what happened last quarter. And so that's a whole different thing. But anyway, one of the things we look at is, well, what 1.5%. Okay, what's that going to do to the options? And I'm thinking, yeah, you know what? The options could go up about 50, maybe 50% in the next 10 days. I'll take 50% of an index trade. But we woke up on Tuesday, and these things had already more than doubled in value Tuesday morning. So unfortunately, CJ, I had to take the double. I couldn't take 50%. I had to take the double.
Yeah.
One day. And
go ahead.
Because of the big day. That's the biggest day. That's more likely going to be the biggest day of the month. Is the CPI report.
Again, so, I mean, you nailed it, I think. It's that old, right now, especially the way that this market has been kind of setting itself up. With the VIX being as high as it is, the thing you said out of all that, Tom, was these 1 and 2 day moves are making your month. They're absolutely making your month. So I can't think of any better time to be watching, things like the seasonality that's kicking in, because CPI gave us that boost, but the market was set up for it. Let's face it. This was a perfectly set up market.
So you're looking, folks that are watching this podcast right now are like, well, I wish you'd have said something last week. I mean, we kind of did say something last week. We didn't go into details, but here's what I'm going to show everybody. So this is the week. This is next week. This starts today and goes to next Friday, which is Thanksgiving. So it shows that the S&P on average, 9 out of the last 10 years has gone up for an average return of about 1%. So what's 1% in SPY terminology? About 4.5 points right now. So, what you do is you look at your options and you say, all right, I could buy SPY and I could shoot for that 1.5%, or I'm sorry, at 4.5 points, or maybe I buy a call option and I have to see if the call option is going to return, that 4.5 points is going to return more than the call option costs. And if it does, if it does, great. If it doesn't, then we look at spreads. But you can see here, this is what the SPY has done for the last 10 years. 2013, it went up 1.2%. Look at last year. Last year, it went up over 3% just in the week to Thanksgiving. The only loser? Well, you got to go back to 2018, where we dropped 1.39%. But 9 of the last 10 years, buying the week before Thanksgiving, the 5 days before, and getting out that Wednesday, okay, because that's before Thanksgiving, it has resulted in a 9 out of 10. Now, there's no guarantee it's going to happen again, but I'm showing that to everybody on the podcast to give you an idea of what we do as pattern traders.
Yeah.
So,
another thing that stands out with that chart, Tom, and I think it goes great with the conversation you and I had 2 weeks ago, I believe, about seasonality and how it's kind of that self-fulfilling thing, or when the market's got that steam behind it, or where you have it set up. 2018 was one of those years where seasonality did not work out into the end of the year. We did not rally through December. 2021, remember, we took off, we went higher, and then we came right back down into December. So that's, if you're looking to try to, I guess I'm asking the question, if you want to extrapolate out a little bit further, and if we want to look beyond, what's going to happen here in Thanksgiving, did this just give us the boost we needed to have that strong December?
It was the starter. It's kind of like when you start in a car. It was the starter to turn the engine. But here's last year. So last year SPY opened at 390 on day 5, 4, 3, 2, 1, and it closed at 402. So 390 to 402, that's 12 points. That's that 3% we're talking about. So you know what? I'd like to thank, if I were accepting an award, I'm holding my money reward for this week. I'd like to thank the CPI report, and go hug a Home Depot employee too, because that also came out that, as well, that really kind of pushed the markets. Home Depot, people were looking at the home building index and they were not excited about it. That homes in general, this whole thing that, interest rates are, the mortgage is 7% now for a 30-year mortgage. And so no one's going to go out and buy. People are buying, but they're buying with cash. And, there may be some pockets in the country that are not doing well. There may be some houses that are sitting on the market longer than they normally are, but there's still people out there buying. And I think they call these people baby boomers, because I don't know too many millennials. I'm a Gen Xer. I like to call myself Gen X number 1 because I was born in 65, and 64 was when they ended the baby boomer era, and 65 is when they started Gen X. But I don't know too many millennials that got the kind of money in their pocket to pay for a house with cash. I don't know any Gen Zs that are looking for houses and buying them with cash. Maybe a few Gen Xers, but these baby boomers are the ones with all the cash. And they're looking and saying, hey, how can I get some good return on an asset? I'll buy a house and rent it. And that's really what's happening. Outside of companies. But hey, Home Depot, golf clap for you. You did help the slingshot. So, I mentioned Home Depot, which brings us into the next thing I want to talk about, CJ, which is retail stocks. So tell me what you see happening here with retail stocks, because we're about to start the earnings phase for a lot of retailers, but we're also going into a holiday season too. So what up?
Well, I think, you know what? I'm looking at this trade right now as we've heard the term, the wall of worry. I think there's a great little wall of worry built around the retail sector right now. When you look at Home Depot, it told us that the consumer is out there, and even though they're interest rate sensitive, and Home Depot sells a lot of things, refrigerators and all that stuff that you got to finance, they still are right in that do-it-yourself niche, right? We're getting out and we're spending. And Home Depot gave us a warning. They said that they see it still being a little bit soft, but the numbers were good. Not ironically, you got that same message from Target this week as well. So we've heard for the last 2-3 months about how bad the consumer is, what kind of shape the consumer is in, and they're pulling back and they're not spending more on Christmas. And you and I've covered that. But that, when you look at it from 5,000 feet up at a sector like this, it kind of sets you up for a wall of worry trade. Everybody's afraid of it. But at the same time, when you start getting these positive catalysts, man, all it takes is a break above some technical levels, which is what we're seeing right now on a number of these retail stocks, that momentum turns into something a little bit faster and you get an aggressive move to the upside. Seasonality is good for the retail sector. It typically tapers out after Thanksgiving. I think because of the way that we've set this up, normally that seasonal trade for retail goes from the day after Labor Day to the day after Thanksgiving. We haven't seen that. I think it's a delayed, it's kind of like a fuse, 4th of July, when you light that bottle rocket and it doesn't go off and you kind of sit there and wait and you're not sure whether you want to go and, throw some water on, and then all of a sudden, whoosh. I think that's what we might have here. And if that's the case, the retailers that have been leading, and we'll name some names in a second here, I think they'll continue to go. And those that have been left behind, like Home Depot, are going to play a game of catch up. It really is a slingshot trade for the retailers right now.
Take a look here. Here's XRP. Okay, here's the retail. Here's the retail sector itself, the spider sector, XRP, and this is the beginning of the year. So in the beginning of January, all looked well coming out of the holiday season. They ran this thing up to about the end of January, beginning of February, and then we started. That was the high for the year for a lot of retail stocks, was February 1st, because we dropped from, in this case, 74 down to the 50s. That's a big drop. We rallied. We could not get back above this retracement level here at 67.74, and then we dropped back down. And it was looking like retail was going to come back down and get crushed even more. Now, what's happened? This is just the last this is just this week where we jumped from, let's call it 59, all the way jumped up to 64. There was a 5-point move, almost a 10% run up just this week on retail. Is that the aggressive move you're talking about?
That is indeed. And that is that coiled spring, that sentiment behind it being so soured. And once everybody wakes up and realizes that there's something there, you get that aggressive move. I think you get a carry through. You test that, that retracement, that 50% retracement that you're looking at. And quite frankly, I think people are going to try to catch up. Retailers, I think, are up 5% for the year. 5%. Now, when you compare that to other sectors,
like technology, having its best year ever.
I mean, Tom, the cubes are up. The NASDAQ 100, which we all know holds those magnificent 7, you're up 45% since the end of 2022. 45. So 5%. It's going to play a catch-up game right now.
I do kind of feel like the contrarian might be the smart move going into the end of the year, maybe even 2024, because it just seems to be too much crowding going on into the Magnificent 7. But time will tell. Here's retail. Happy Halloween with XRP down here at 58, and all of a sudden we went from a trick coming into this week to a treat as we jumped out quite a bit there. And, for aggressive traders that are looking at retail ahead of earnings, maybe this is the spot to start thinking about, jumping in. You saw Home Depot, get a surprise to the upside, big surprise. Target, Target's having double-digit numbers to the upside. What's that to say for other slingshot retailers? And so, we'll take a look at a few of them here real quick. So, we talked about Home Depot. I just want to show you the chart of what's happened. I mean, this stock was down to 275, and all of a sudden 275 is now back above 300. And it really started this week. You just saw this bang, bang, just big move up. And you know what I like, CJ? I like what happens the day after an earnings report where a stock pops, because a stock can pop on earnings report day, and then a lot of times it just starts to slide back down and fill the gap. That's not the case for Home Depot. They popped up after earnings, and now we're running away from that gap. They call that a runaway. That's a very, very positive move. Take a look at now. You wanted to mention American Eagle. So talk about AEO.
AEO has been on fire, Tom. And behind any stock that is up the way American Eagle Outfitters is, and I mean, if you put it into context, we just talked about the XRT being up 5% for the year. It's up 5%, more than 5% this week. The stock is up 40% year to date. This is what I refer to as inelastic retail. So, in other words, think about who shops at American Eagle. I don't. I don't know. Maybe you do, but for the most part, it's the the college age kids and the high schoolers.
High
And
schoolers. They got great price points.
Yep.
They used to be, the price points used to be like, everyone looked at what the gap, not they looked at what the big mall stores were doing. Hollister, the guys that own Hollister, they had a company called Rule for a while, which was after college. And then you had that college crowd. And I'm trying to remember the name of the companies. They all were all right next to each other. And they looked at these big names and they said, whatever they're pricing, we want to come in right below them, but still high.
Yep.
But now that's not the case anymore. We've seen clothing stores, retail stores drop huge. They're right in a sweet spot, I think, in terms of price points where they're still making profits.
Yep.
And they got customers coming in. And so that's great. So how about Walmart?
You know what? Hold on. Let me throw another one in with that or the AEO, the American Eagle, Abercrombie and Fitch. Tom, nobody talks about this, and
that's the one I'm talking about. That's what I'm talking. The Abercrombie they had a couple of they had a younger store, I think, with Hollister. They had an older store, Rule, and they were sitting in the middle. They were under some controversy last year because of what they called modeling practices, who they hired, but that's behind them now. And so
well, Abercrombie and Fitch is up, get this, 210% for the year. 210% for the year.
Isn't it isn't it interesting? There's Abercrombie. There's a 75-day chart of Abercrombie, and it's you're talking about almost doubled in value just in the last 75 days. Again, it's they're under new management over the last year. They basically avoided, and by just changing the folks at the top, they literally got a pass from the consumer. And here we go.
They are, and
I don't know what the price points are. They're probably still high, but by just changing, by avoiding the cancel club, they were able to turn this thing around, and kudos to them.
That's right. And let's not talk about the fact that I used to stand in front of an Abercrombie and Fitch. Little known secret there, Tom. I was the guy that was welcome everybody in.
Yeah.
No, I was not. That's a joke.
I was going to say, you might have been the one that started the cancel
Walmart
in the first place.
Bringing that back to Walmart, where I'm more likely to be the guy standing out in front. Tom, this is the inflation buster, right? They've long been known as the inflation buster, and they're finally, holding up to that job. It was a rough 2022 as we really hit into some inflation there on Walmart, but this stock has got legs on it, and it is once again back as the inflation buster.
This is the beginning of the year at 60. Here's where we went all the way to 75. We dropped all the way down into the mid 50s. We're kind of right back. We're actually above where we started the year out, but not by much. But like you said, this is the one that may rubber band itself back to the other retailers, in kind of they're the caboose right now and not the engine. And so, there you go. Okay. Well, here's Walmart. My bad. I had XRT up there again. I was looking at you. You were looking at me cross-eyed. So here's Walmart, 145, and now it's at 170. It definitely is not the slingshot, but it did slingshot over the last month, coming off this 50% retracement level at 152. Right. That's what happens when I take all the stocks, I throw them into a thing. I make one little change and we start over again. And I tend to forget about that sometimes.
What's interesting there?
Let's end the retail sector with Target. So what the heck is happening to Target today?
Well, You talk about, beating the odds, or I guess this would be a wall of worry trade. Target's given us nothing but bad news over the last couple of earnings seasons, and they've really braced us for impact. And I'll be darned, they came out and they beat expectations. They gave an outlook that was better. They said shrinkage is going down in the stores. Now, remember, they closed some stores because of shrinkage and caught some backlash for that. But let's face it. They have to run. They have a company to
They got to
run.
run a business.
They got to run a company. So,
I mean, yep, I'm looking at, like, here you go, 220 days back. That takes us back to the beginning of the year. And you're right. I mean, we were, this thing was back up here around 180. And then this fall off that happened in June, that was that whole problem with the LGBTQ plus community.
right.
And it was not them. It was everybody else. They got pissed because, maybe it was store placement or whatever it was. I don't care. All I care about is that stock price. And that stock price got hit really hard. And at the same time, I think Bud Light was also suffering really hard. And Anheuser-Busch parent company was suffering around the same time frame. And what happened since then? Well, you know what? They were beating estimates, but up until now, their outlook wasn't so great. They were a future outlook. They were like, I don't know. Isn't it interesting? If you look around now, where did the cancer group go? The cancel group. Now it's like, what do you mean cancel? We didn't cancel anybody. They look at us like a bunch of old people, like, you don't know what you're talking about. We didn't cancel anybody.
Very interesting you bring that up. I typically don't like to get political, and I don't think a lot of us do when we're talking about stocks, because we look at the numbers. But I saw an article in Bloomberg last week that actually it was talking about how that cancel culture against companies is being canceled itself. As people just start looking back at companies for what they do, which is, as you just mentioned, run a business.
People in general, like, whether you hear about, to me, you have, everyone, people in general want exclusivity. They push for inclusiveness. But when you're sitting out here, talking about a topic that most people are not talking about, you're not inclusive. You're exclusive.
Yep.
You're a small group talking about a big a topic that you want the bigger group to gravitate around. Once the big group gravitates around it, you're not exclusive anymore, and you're moving on to the next thing. And I think that's exactly what the cancel community did. They canceled people, and they got their 15 minutes of fame, but then all of a sudden they became the majority. They didn't like that, so they stopped. And I bring that up for no other reason, folks, that if you're in the investing world, pay attention to this. All right. When you're a small group that's on, everybody's a seller, and all of a sudden you're a small group of buyers, you're more than likely on the right side until you become the majority.
That's right.
That's what's happening right now, is that you're seeing now people are looking back to retail and they're saying, oh, wow. We were all canceling and we hated retail because of this, that, and the other. All of a sudden, retail's going up right now, and part of the reason why is because the short sellers went from being a small minority to the big majority. And once all the sellers are out of the market, there's only one place a stock can go.
Up. Yeah. Hey, Tom, you mentioned something. I'm just going to slip it in. It's not in our agenda or, our syllabus for the day, but short squeeze. Over this week, we've seen the short interest stocks, the highly shorted stocks, go up 5 times, as much as 5 times what the rest of the market has. It's always kind of one of those things I like to point out. You get these big, huge moves off of CPI and PPI and all of that, and you're going to have a lot of short covering. It's one of those things where the water's still not safe to get for companies maybe like Carvana or, those highly shorted name. Just something to our listeners out there. Kind of check that if you look at a stock that's run 25% today.
I know a name. I know a group that's been getting that has really took it under the chin. It is the solar group.
Yes,
You
clean
take
energy.
solar, and you look at like Sun Power is one of them. SPWR,
Yep.
I believe, is one that just got murdered.
Yep.
Look at it. I mean, and we're talking about a $20 stock that came down to $4. But look what's happened in just the last. Let me put the 20-day chart up, and you can see pop, pop, pop. And
Yep.
we're talking from 4 to 5. That's not a huge move up. But then you've got some of the others like Enphase Energy. Enphase Energy, you and I have talked about before. ENPH. Yep. That one, I'm long this one, but I'm not long it down here. I'm long it up here.
Yeah,
I'm long it at 100, and so it came all the way down to 75. Well, look what's happened just in the last 2 days, last 3 days. 1, 2, 3, yep. Back up to 95, almost back up to 100, because the shorts are running for the exit door on a lot of these, yep. and that's one that has happened to as well. Another one that got hit really hard, it was retail, is Kohl's, KSS.
Oh, yeah.
Take a look at Kohl's and look what happened. 25 down to 21, and then 1, 2 back to 25 again. And this was just the last 20 days. Kohl's been all over the place. But you're absolutely right. The short sellers are getting squeezed. Now, yep. I'll mention this. Most people that are in the short selling business are not the retail public. This can be hedge funds. This can be institutionals, right. Big money. But big money is, it decided a couple of days ago that, all right, enough's enough. Regardless of whether I hate this stock or not, maybe I need to step aside because of the macro environment that's going on right now.
Exactly.
And so there you go. Let's talk about our final topic of today. And our final topic of today, if you're reading along with us down at the bottom, Bitcoin's test. So was it a week ago, CJ? Yeah. We were talking about Bitcoin, and we were talking about the fact that BTC needed to get above. It was actually in the last few weeks. We needed to get above that 35,000 level and stay above it. And look what's happened in the last 7 days. I mean, we're above 35. We're 36. We're 37. We almost hit 38 on an intraday high about 6-7 days ago. And since then, we've had a bit of a pull off. In fact, it's interesting. I said this before, that Bitcoin became a trade of uncertainty. Instead of trading like an asset, it traded like uncertainty, which was great because that's what we wanted to do. Well, that's also what happened when the CPI report came out. Everything went up except Bitcoin. Bitcoin and crypto went down, but they've started to recover even with the rally, because there's folks out to say, well, wait a minute. This isn't a complete asset. This isn't complete uncertainty. This is a finite instrument, and let's not forget about it. And there's some things that are happening that are going to be happening over the next 3 to 4 months, CJ, that is going to even put the constrictions down even more on what's coming out.
Yeah. I mean, that chart that you just had up, first of all, that 35,000, and you're looking, explain everybody real quickly the Fibonacci that you're using there, because a lot of people see that.
So what I'm looking at here, and let's just zoom in, is that I'm taking different points in time, low points and high points. So what I did was, the last time that we were kind of sitting here, in the trough, was around 25,000. So I snapped the low at 25,000. That's the low over the last 75 days for BTC. The high, and this is a closing high, was a little more than a week ago when we hit 37,321. So if I go from 25 to 37, these are pullback areas. If we pull back 38% from this low to this high, the 38% pullback puts us at 32,676. The 50% pullback puts us at 31,241, and the 61.8% pullback, well, that's 29,806. Mm-hmm. These are areas that, if the market were done running to the upside, these are areas that I like to be a buyer on, but only when a certain instrument is creating higher lows and higher highs, meaning it's moving in an upward projection. I like to see if there's any pullback areas that I want to be a buyer in. And these are the areas that I would be looking at today. Now, it all depends on where you set the bottom to the top. So if I take this and I say to myself, well, what was happening a year ago with Bitcoin? Well, I know what was happening. FTX, fell off the grid, filed for bankruptcy. So that was 365 days ago, because remember, Bitcoin trades all weekends and holidays. So we have to go back and look at the 365 chart. There it is, all the way down here below 16,000. Then we started that series of higher lows and higher highs that took us up to the 37,000 number we are at today. If I were to take the absolute low in the last year and the absolute high, I'm going to get three different numbers. I got a 38% pullback. That takes us to 29. The 50 is 26,550, and the 61 is 24,000, a little over 24,000. But that's based on the 1 year chart. So, I like to look at these. And again, you can see here's where I grabbed that last move. We had that move up, and this was what, July. We had the pullback that took us from just above 30, I think it was 31,000, that took us back down to 25. And this is the area I started that most recent chart from. So when people say, well, where do you get your Fibonacci's from and how do you use them? I look at low points. This is a low point. 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 I take the most recent low point to the most recent high, and I look for those pullbacks. So that's where I come up with this information.
Gotcha. Love it. I love that 35,000 level. It also, from a weirder perspective, I look back to the beginning of that bull run that we saw in 2020 and went all the way to the highs in 2021. 35,000 is a 50% retracement. So, Leonardo da Pisa, who was the guy that put together the Fibonacci, knew what he was doing back in the 1200s. But
and what did he get for it?
What's
what
that?
did he get for it? You got a statue somewhere in Italy that is in desperate need of cleaning because of all the bird poop that's sitting on top of it.
He got more than I did. A statue in Italy is pretty cool.
Yeah.
But let me ask you something, Tom. On the subject of Bitcoin, we've talked about 35,000. If we break through that 45,000 or that 40,000, where do you see the next line for Bitcoin?
47 to 50 is my number, and that's my number by year's end.
End.
I'm looking at the 47,000 area. The only reason I say 50 is because 50 is a round number, but 47 is a very interesting target. And the way we came up with that is we take that slingshot where you get that low to high to low to high, and we just add that distance between the last high to pullback to the high, and that gives us that 47,000 area. But there's a lot of things that, it's nice to be able to come up with technical targets. Technical targets are something that I like to do in a year or less.
Right.
But Bitcoin has some very interesting things that are happening to it. You've got number one, you've got ETFs that are in the process of potentially getting approved. And I know people are saying, but there are already ETFs that got approved back in 2021. Yes, but those were ETFs. Those were easy approvals because they were ETFs based on futures contracts that were already existing. The approvals that Larry Fink, the folks at BlackRock, Investco, and others that are lining up ready to go, they're looking for approvals on Bitcoin itself, on the actual physical. And we did a little bit of research, and we're already trying to figure out, if you take a look at an ETF, the average ETF, it has billions of dollars behind it. And so, average ETF is what, 8 to 10 billion for these firms. So if we had to go in and that Bitcoin ETF was approved, and 8 to 10 billion had to be added to that ETF. And then you take the number of ETFs that want to also have a Bitcoin ETF as well. You're talking about, you're looking at $500 billion, I think, within, let's call it the next cup. It would be at least a year, if not more. But let's say in the next year. I mean, $500 billion. You're talking about right now the cryptocurrency market. If you look at crypto as a whole, I don't know what the market cap is, but on Bitcoin, we hit the $1 trillion market cap when we were hitting all-time highs. We're not there right now, but imagine if we had to add $500 billion or more. You're talking about the idea of Bitcoin being somewhere around 150 to 200,000 per coin. And then there's Larry Fink, the BlackRock also approved that someone had gone out and seen that there was a approval. It was a Delaware Corp for an an Ethereum ETF, the Ethereum Trust, right? That corporation, if you want to call it, has been already taken now, and BlackRock's getting ready for an Ethereum-based ETF, which is why you're seeing Ethereum making the kind of moves that it has.
Yeah, you know what's funny? I just looked up the Grayscale, which obviously they're tangled up in the ETF. Their Bitcoin fund's 20 billion right now, 20.1, and then their Ethereum is 5.4 billion. That's going to look like a drop in the bucket. I mean,
Yeah, I'm being very, very conservative because you know what's going to happen is if BlackRock gets the approval, what do you think GBTC is going to say? You know what? We want to change. We want to be a physical based ETF because
correct.
the management, not the management fees, but the contango spreads are killing them right now. And
Right.
so if they can get off contango, it's going to be good for them. And so you're going to see a lot of ETFs that are already futures-based ETFs. They're all going to want to climb into it too. It's going to be massive. It really is.
And it'll be good for investors too, because right now you just mentioned the contango. You can look up on a daily basis with Grayscale Bitcoin, GBTC, what their premium or what their discount is to spot, to actual Bitcoin.
Yeah.
And that can be frustrating for investors. Like let's say my mother, or my sister, somebody who doesn't know, to see Bitcoin go up 7% or 9% in a day, and then ask that question, well, why did my ETF only go up 3%? Well, guess what? It's because of that premium or that discount that it's trading.
And
you'll get a spot then. It'll be nice.
Yeah. Now make no mistake about it too. ETFs can be shorted.
Oh yeah.
So this isn't going to be all on the buy side. So
Oh.
don't think that this is just going to be 100% buyers. I mean, it will be in the beginning when they actually officially open them for trading, but eventually then afterwards the short sellers are going to come in. There will be options created for these ETFs that will trade on CBOE,
Yep.
the Merck, and so you've got all these instruments that are going to be hedge instruments against it too. But the sheer fact that this is potentially something that's going to push Bitcoin into new all-time highs, I think it's very, very doable.
Yeah. Hey, let me sneak one in real quickly because I know we're giving people an extra size. We're doing super size on the podcast today. But since we're on the subject of Bitcoin, you mentioned last week halving, and that there's a halving coming up.
Yeah.
And Tom, here's where I bare my investing soul to you. I don't know what a halving is with Bitcoin, and I don't know.
It's definitely not it's definitely not. I have more Bitcoin than you do.
You do, but
it's not that kind of halving. So halving is. So think about this. When I started mining BTC back in 2013, what we do is a digital, like a miner. When you mine gold, you have a pickaxe, and if you dig deep enough and you find the right vein, boom, you get rewarded with gold.
Right.
Think of Bitcoin mining the same way. So Bitcoin mining, we're digitally mining. We're going out there trying to solve mathematical equations. And when we solve the mathematical equation, then we are rewarded with Bitcoin. Back in 2013, if you were able to solve mathematical equations or add verification to a verified block, you then get a block of coins. And we were getting 50 Bitcoins back at the time, when you were solving this. Now, what I did was I went in with others and we shared those rewards. That was a mining pool. Anyway, those 50, when we came to the first that I'd seen, the first halving that occurred. Halving is where, as you mine gold, it gets more difficult because, the easy stuff's at the top. Then you got to start digging deeper. You might need more machinery. You might need a bucket, instead of a shovel. You might need equipment, machines. Well, the same thing happens with Bitcoin. As we were mining Bitcoin, the easy Bitcoin to mine was prior to 2014. Then 2014, as more and more mining happened, there was less and less there in the digital ground to get. And so the way that that Bitcoin was set up was that roughly every 4 years, the amount of reward you'd get from solving an equation would be cut in half. So 50 became 25 in 2014, and then 25 became 12 and a half, 12 and a half became 6 and a quarter. We're about to go to 3.12, and that's going to happen in April of 2024.
Okay.
So it's just the rewards are getting less and less and less. Think of it like Halloween candy. You know, back when you and I were going trick-or-treating, we got the big candies. There were no such thing as a fun size.
Right.
Now we're competing against more kids, you know, because even some of the adults are you know, the young adults are still getting candy too. But now the candy's getting smaller and smaller. The same thing's happening with Bitcoin rewards. They're getting smaller and smaller, and they're going to keep getting smaller and smaller. Well, we have a halving, a reward cut is going to happen in April 2024. We've done all the research we've done says that the year prior to the halving and the year after the halving, we run into a Bitcoin bull. Look at what's been happening now for a year. We hit, you know, crypto winter ended last year. It ended last November, and we've been digging our way out. And all of a sudden, 15, 16,000 is now in the upper 30s. And so if this trend continues, we should see Bitcoin, Ethereum, and other cryptocurrencies continue to go high throughout 2024, maybe into the beginning of 2025 before we hit any real, you know, leveling off. So it's an exciting time. So I think it's a very exciting time to own Bitcoin and to have it as a more aggressive form of investment. But just like aggressive forms of investment, you don't want to load up and have. I don't have more Bitcoin than I've bought. I've mined some, great. But I'm not running out there buying as much, you know, buying into as much as I have in a stock account or a bond account or whatever. You know, you don't need that much because the volatility there is insane. The volatility on my my crypto is, I mean, it's double digit. It's 10, 20x all my other stuff combined. So I wouldn't even need as much of it as I'm looking at it as an investment.
Okay.
So, there you go.
That's good. Now I understand it. So they're basically creating scarcity as they do these halvings.
Yes. And by the way, the last Bitcoin is expected, the last piece of Bitcoin is expected to be mined in 2140, the year 2140. So 115 years, 116 years from now, they expect the last one, the last little bitty piece before there is no more to be mined.
Gotcha. Okay. Good to know. All right.
Awesome.
I have gained my crypto experience for the day.
All right, CJ, we're 48 minutes into this podcast, so a little longer than we normally do. But that was a lot of fun. Guys, we are going to take the week off next week because it is a short week. We got Thanksgiving coming up on Thursday. So CJ and I are going to take a little siesta. So we hope all of you have a great Thanksgiving holiday, and we'll see you on the other side. Thanks, everyone. Have a good one.
See you later, guys.